Hello, am I audible? Hello, am I audible? Nana, can you confirm, am I audible?
Hello, everyone. Am I audible?
Yeah.
Yes. We are already live, and I welcome all to our webinar today. We'll explore the topic Unlocking Growth, Structuring ESOP Models across USA, Singapore, and India. With actionable insights from our expert speakers, Mr. Shomik Kumar Sen and E.T. Agarwal, with expertise. Yes, you're audible.
Yeah.
Right. With expertise in global expansion and fundraising.
Anana, you are echoing, and I think there is a lot of background now noise. So let me take this forward. Good evening. Yeah. Good evening, ladies and gentlemen. Great to connect. We have come with the latest episode on a series around the compliance and regulatory aspects of various cross-border issues. So many a times when cross-border structuring takes place, one needs to take into account the ESOP aspect. Now, ESOPs are very important, pertinent of every structure because as of the latest and the new trends in the business world, especially the startup ecosystem, ESOP becomes a very important component of any structure. And hence, how these structures and ESOP will impact the overall scheme of things. In this webinar, we will try to dig deep in each of these aspects from RBI, income tax, and other regulatory scenarios, and we'll try to analyze each aspect and what's the best modalities in case of each of the schemes in ESOPs around the tax and regulatory framework. To start this webinar, let us first understand what is an ESOP, right? So ESOP is a very powerful tool to attract new talent. This is what we all understand, right? ESOP on our regulatory framework is a sort of tool to which employees get benefit of the appreciation of the shares of the company. Now, it might be on physical aspects, it might be on cash component, but ESOP calculation and ESOP issuance becomes a very pertinent part of the compensation structure of any startup. So the thing of ESOP is that they can attract new talent and they can also help in retaining the employees. So ESOP plan is a sort of a benefit program that allows employees to purchase or receive company shares and align with the interest of the company. Now, these shares might be in form of stocks or in terms of cash component. Each of this aspect I will discuss more in the latest slide, but let us understand what's the benefit of ESOPs over here. A, you all know is to employee retention. B, for better productivity, it will improve the overall morale of the company, and hence it's very attractive to the attract talent, right? Now, What are the benefits for ESOPs for the employees? It helps to get some sort of ownership of the company, and it becomes part of their family, because in the startup ecosystem, it's very important that the key employees become a part of the mission and vision statement of the company, because a lot of processes are to be built, lot of processes are to be broken and then again rebuilt, right? And hence stock ownership becomes a very important part, right? The dividend income will come in from employees, and in fact, in most of the cases, especially in the startup ecosystem, you get the ESOPs on a discounted rate, right? So there are some tax aspects, but that is some benefits that an employee get, that without spending much, they become a part of the capital of the company and the growth of the company. That's very important in the early stage of any startup, right? Now, let us now understand the different type of ESOP. The traditional ESOPs are employee stock option plan, wherein you get stocks of the company after a particular exercise period, and after you get it at the grant level, and then you can purchase it either on face value or in no cost, right? You get actual shares of the company, and you become the part of the cap table of the company, right? However, nowadays what is happening is that rather than being on the period, right, people are measuring on the type of the milestone that an employee can achieve. So, say for example, for a sales team, what we're seeing in the startup ecosystem, it says that if you can give me an ARR of certain milestone base, then I will give you this much worth of ESOPs. Now, these are covered in the ESOPs and RSU system, right? Once you get some milestone, you can get ESOP. Now, one can be the hybrid model. So, say for example, I can say कि if you stay so and so, and you give me this ARR of revenue, then I will give you this much of ESOPs. Okay. The latest thing which is also coming, and due to regulatory uncertainties, especially on the cross-border angle, is the rise of phantom stocks or SARS. Now, over here, what happens? You do not give them equity, right? You do not give them physical stocks. What you give them are cash component. So, see, for example, my valuation is 10 CR today, right? And per share value is, say, 1000 rupees. Okay. Now, tomorrow, if my valuation increases after a certain amount, then each employees will get those amount of worth of money. So say for example, I had 100 stocks when I joined in of 1000 each, and after 3 years, while I stayed in the company, my stock improved, and the value improved, then and the value improves to say 10,000. So after 3 years, I will get 9,000, 10,000 minus 1,000 into 100, which is somewhere around 9 lakh INR. Now, what is the benefit of SARS? This SARS doesn't become a part of the cap table. Okay. The entrepreneurs, the founders can differentiate with the cap table management of the company, right? And this why guys cannot get EGM notices or key decision making issues. The entire control still lies with the entrepreneur. However, the employee get all the reward that is required in regards to the ESOP program. So SARS and phantom stocks is quite a new revelation, and people are coming to take the benefit of the same, right? So that's the next part of it. Now we need to understand the important terminologies over here. First, in terms of ESOPs, there is a concept called options. Option is simply the right. Now, if I say ki I will get 1,000 option, then I get the right of buying those shares, right? So that's point one. What is grant? Grant is an act of offering the stocks to eligible employees. So I am offering you the stocks, that is called grant. And grant is offered by the company over here. What is vesting? Vesting is the period till which the company can exercise the option. So, say for example, after 1 year, uh, then in this tenure of say I'm getting 100 shares, right? And I will be giving them over a period of say 4 years, 25 each, right? This entire period is called vesting, and the date of each vesting, say 25 of each year, is called vesting date. The date on which the employee say, okay, fine, you have given me, you have offered me, and my vesting date has come, I am willing to purchase, is called exercise. The price at which I am eligible to purchase is called exercise price, and the duration by which I have to confirm a yes or a no is called exercise period, right? So these are the important terminologies of any ESOP program. The procedure of ESOP, because we have been part of ESOPs for various companies, including unicorns, it will be first finalizing the terms at which these things will happen in the RBI and FEMA compliance, the ESOP policy adoption, the grant of ESOPs, right? Now, once the policy is adopted by the company, the offers has to be made, the grant of ESOPs will be done, and the vesting and exercise schedule will be followed. So this will be the entire procedure of setting up the ESOP structure. Once the exercise is done, the payment of exercise price will come in, and once the price is being received, then the allotment of shares will be triggered. Now, it is to be noted many a times the payment is not received. Only a token money is given, that is also covered as payment of exercise price, right? So these are the important structure and the procedural aspects of the ESOP plan. Now let's understand the various types of regulatory framework of governing model ESOP, right? The first will be, and when I say this, I am concentrating on the Indian side of things because Indian startups will be important over here. So the RBI aspect is very important. The income tax aspect is very important, and the Companies Act aspect is also very important from the Indian perspective. So if the employees are in India, or the company who is issuing the shares are in India, or the subsidiaries in India, this regulation will come into the picture, right? And in this note, let me invite my colleague Iti, who can explain each one of them on a far detailed way. So over to you, Iti. Let's start on the eligibility criteria of for ESOPs. Over to you.
Yeah, thanks, Shamik. In this presentation, now we are going to discuss on how ESOP is issued by foreign. So there are two scenarios when ESOPs are issued. ESOPs issued by Indian company to foreign employees and foreign companies. So basically, these are quite familiar structure happening now. Foreign holdcos issuing shares on a uniform basis to their subcos in different geographies. So we are now going to cover when foreign companies issue shares to their employees in India, whether in its subsidiary or any entity in which the foreign holdco has indirect or direct holding, or through its office, through its branch offices. So the eligibility criteria for such a situation where foreign companies are going to issue to its employee in India are: point one, the employees should be the employees of their subsidiary. So India, in there should be an established Indian subsidiary, and employees should belong to that Indian subsidiary. Next is that the employees, there must be a director or an employee which have an office in India or have a branch or overseas entity, then there should be, or either it should have a subsidiary in India of an overseas entity, or an Indian entity in which overseas entity has a direct or indirect holding. Now there is a crux for indirect equity holding. When we say the word indirect equity holding, it means that indirect foreign holding, it should be through a special purpose vehicle or should be through a step down subsidiary. So basically, the RBI is trying to capture and reach out to the ultimate beneficiaries here, and accordingly they wish to fulfill criteria. The overseas entity should have direct, as I was discussing, the overseas entity should have a direct equity holding in the Indian entity, or through a SPV or subsidiary entity which is controlled by the overseas entity. The next criteria is the foreign company it must have direct or indirect equity holding in the Indian subsidiary, and ESOP schemes are basically offered by the overseas entity uniformly throughout the world. So basically, it should not be a specific criteria where foreign companies are issuing only to their employees in Indian subco. The ESOP plan should be a uniform plan, separated or segregated throughout the world. In this terms, now when RBI says that the Indian entity, the foreign companies are issuing shares to employees, so employees for subscribing to the shares, they also will have to remit their exercise price to the foreign subco, and this will be part of LRS, which we are going to discuss later in this webinar. Now, when we discuss this, we should keep in mind some key RBI compliances or reporting requirements that we have to do. So, from compliance perspective, we have to see whether this is an ODI, whether this is an OPI. So, if in case if it is an ODI, overseas direct investment, or overseas portfolio investment by Indian resident employees, then they should reach out to the AD banks, and AD banks should permit remittances by these employees for their for subscribing such ESOPs within the permissible limits. And employees in this regard, they will have to file Form FC and Form A2 for their remittances of exercise price. For OPI, when OPI is taking place by Indian subco, then the reporting obligation, it falls on the Indian employee, Indian subsidiary of overseas entity, and the entity must file these transactions in a half yearly form, basically on 31st March or 30th September of each year. Now, when we are discussing about the remittances, so the remittances that the Indian employees are going to make, it falls under LRS limit. So once the Indian employees are going to remit any kind of funds to this holdco, it will fall under LRS. So firstly, the LRS limit will get used, and post that, the LRS once the LRS limits get remittances gets covered, it is not restricted by it, and amount can exceed the LRS limit of 250,000 US dollars. Now, discussing further, now how ESOPs, so what are the benefits when ESOPs are issued by foreign companies to Indian employees? So when the foreign companies issues to its Indian employees, it will be regarded as foreign assets, and the foreign company is should comply with securities and exchange commissions regulations in their home countries. They should also communicate whatever the terms and conditions of ESOP schemes to all their eligible employees, so that the eligible employees can also give declarations and also make compliances in their home country as well. India being a highly compliant country, the employees herein has to make a lot of compliances in RBI Companies Act. and as well as the ITR, the tax regulations. Now, ESOPs are basically taxable in the country where employment is exercised. So, therefore, in such situations, DTAA becomes very handy in order to avoid the double taxations. Now, whatever the tax compliances that the Indian employees has to adhere to, employer must know what the regulations, certain regulations, and they must include reporting grant of ESOPs to their tax authorities as well. And for the employers, GST is not applicable both in employees case as well as employers case as well.
Yeah, Iti, I think we are unable to see your screen. Iti, I think we are unable to see your screen.
Just a moment, I am resharing it. Now, is this visible now? Yeah, moving forward, now the income tax, for the employees perspective, they have to pay taxes on the difference amount between the excel price and the fair market value of the shares. Moving forward, we are now going to discuss how ESOPs are issued by Indian companies. What are the factors that the Indian companies consider when they issue ESOPs to their foreign employees? Now, the rules that governs this allotment of ESOPs are SEBI Act 92. Then there comes Companies Share Capital and Debenture Rules 2014, the Companies Act and Income Tax Act, of course. We have to consider the RBI regulations as well. Now, ESOPs, when the Indian companies are issuing ESOPs, they will have to consider the sectoral cap. They will have to see if when the company is being made by a person who is resident out of India, and if it falls under approval route, then they will have to take prior approval of central government as well. Same case falls for ESOPs shares that is being issued to citizen in Bangladesh or Pakistan. The Indian company, it is required if the Indian companies are issuing ESOPs, then they will have to furnish a return in prescribed forms to RBI. So the prescribed forms that we are going to discuss ahead is form ESOP, form FCGPR, FCTRS as well. Now, what reporting that we need to do, as we've discussed, it when ESOPs are issued to employees resident outside India, it is termed as FDI, and it needs to be made reported in form ESOP, form FCGPR, and form FCTRS. So basically, there is two criteria when we consider this. One is cash-based exercise, and then there is cashless exercise. So when it is a cash-based exercise, where the exercise price now is paid by the non-resident employee on exercise of options under ESOP, it has to be reported in form FCGPR by the company. And in case of cashless exercises, where shares are where a part of shares, not the entire holding, when a portion of shares it is sold to cover the exercise price, the net shares that is being issued to the employee, it should be reported in form FCGPR. Sorry. Now, in case of cashless exercise, where the company has sold the entire shares and made net payment only after deducting the exercise price, now the same should be reported in form FCTRS. Please mind this, it should be reported in form FCTRS by the company for sale of shares on behalf of the non-resident employees. So basically, we now move forward and discuss ESOPs in different countries. So the angles that we have discussed, it mostly the structure of ESOP that we have discussed in the early stage of the webinar. It most the USA, Singapore, and India. It moves around that ESOP structure only. The main criteria that the differentiation criteria we are going to discuss now is the eligibility. Now USA, it has a broad angle. It can include contractors, employees, and directors as well. It gives a free hand to the company. For Singapore part, it is basically for their employees and directors. However, we can also include advisors here, and the plan, if it contains the advisors to be as the employees of the company, then we can also include advisors. For the Indian, the Indian has a narrower perspective. It is issued to Indian employees, promoters, and directors only, and that should be also within limits. For the regulatory framework, we have to follow SEC, IRS, and DOL. DOL is Department of Labor. IRS is Inland Revenue Service, which is a tax department of US. Then there is SEC's US Security Exchange Commission. So we have to there is quite broad legal framework for ESOPs. Singapore is relatively a smaller perspective, governed only by ACRA and IRAs, which are their corporate law and tax authorities. And for Indian, then there is again the broader frameworks for ESOP. We have to govern by RBI, we have to govern by Companies Act, SEBI, income tax, depending upon the structure of the company. For startup cases, there is quite a popular incentivized tax benefits, and this is basically a qualified small business stock, which actually the benefit here is that it allows 100% of capital gain taxes when you sell a stake in startup or small business. So 100% capital gain tax exemption is here. For Singapore, it is quite common and it is encouraged via government grants. Now, government grants like Singapore Startup Equity, Enterprise Development Grant, Productivity Development Grant, these kinds of grant, it actually helps startups to move forward and also incentivize ESOPs. For India, it is growing benefits for startups, and India is on a tax perspective, India is less friendly. If we move around to vesting thing, the vesting part is quite flexible in India and in US and Singapore, it's quite flexible. And typically, it is 4 years vesting with a 1 year cliff. India also has mainly 4 years vesting, a standard 4 years vesting with 1 year cliff. However, Singapore is quite flexible in this regard. There is no hard and fast for any kind of vesting period. There is no cliff also in Singapore. That's quite an important point to note. For employee benefit, these are the benefits of retirement plans. These offer taxes, and for Singapore, it is also retirement plan offering taxes. And in ESOP, it is basically for employee retention and motivation. Now we further discuss on tax on ESOPs across different countries. Now taxes plays a very important role. Singapore does not basically there is no capital gain tax. However, taxable amount in case of ESOP is current market price minus the exercise price. Uh, when ESOP is exercised, this is the taxable scenario in Singapore. For US, it is not taxable at the time of exercise. And for India also, when ESOP is exercised, it is taxable as per perquisite in the hands of employees at the slab rate that is applicable to the employee. So when shares are sold in US, it is taxed as capital gain. In UK also it is taxable, and for Singapore it is not taxable because capital gain taxes are not applicable and not in Singapore. And when shares are sold in India, it is again taxed as capital gain. So this is the border structure that cross border structures that help us to align the ESOPs in different cross border geographies.
Right. Thanks, AP. Uh, it was a lovely presentation where you highlighted the different types of tax and RBI aspects. We have helping several clients in and around the world in regards to the ESOP. Some of them are already there in front of you. What we try to achieve is that because we have offices in India, US, Singapore, and Dubai, we are trying to align every country geography specific laws vis-a-vis the Indian laws, so that in both the countries, when be it in terms of transfer pricing, be it in terms of DTAA, be it in terms of RBI aspect, be it in terms of the legal aspects, we cover the entire thing and you get a single point of solution. So in this regard, if you have any questions in ESOPs from anywhere in the world, from the perspective of US, India, or Singapore, India, Dubai, India, sort of structures and how your ESOP policy should be drafted, feel free to contact us and we shall be happy to answer each of them accordingly and take this discussion and the relationship forward. On this note, I thank EP and other colleagues of us who have been helping us in preparing this presentation. And we will come back in the next episode with far more detailed aspect from the tax perspective on ESOPs. And we can interact on your specific query on the same. Thank you so much, ladies and gentlemen, for visiting us and going through this webinar. We will come again with the next episode in the days to come. Thank you so much. Bye bye.
Thank you.